What I'm about to show you will change the way you look at every dollar you have saved. Because there is a mechanism quietly written into central bank policy that allows the government to override the market, control interest rates, and quietly transfer the cost of the debt onto savers. But this isn't a conspiracy or a hypothetical. It's already been done. It happened in Japan. It happened here in the US during World War II. And the conditions have never been more in place than they are right now for it to happen again. It's called yield curve control, a desperate option of central bankers and a clear signal that the system as is running out of road. The last time it was used in the US, inflation hit 18%, and American savers were absolutely decimated. But with today's debt being 10 times the size in real value, the fallout would be far more severe.
And as the Fed reaches closer and closer to enacting this, most Americans would have no idea what's happening until it was too late. But the heart of the crisis, the thing that's pushing the Fed towards this option, is the debt. The US owes $39 trillion. But it's not just the size of the debt that's the problem, it's the speed at which it's growing. And right now, the fastest growing line item isn't defense, it's not Social Security, it's the interest on the debt. 5 years ago, the average interest on the debt was 1.5%. Today, that number has more than doubled to 3.3%, which might not sound like a lot, but when we're talking about nearly $40 trillion, that equates to hundreds of billions of dollars annually just in interest. We are paying more to service the past than we are to build the future. But here's where it gets worse. The buyers are disappearing. Just last week, the U.S. Treasury had 3 major auctions. All came in weak, meaning the natural demand wasn't there. So they were forced to raise yields to attract buyers, and it still didn't work. Primary dealers, aka the big US banks, your bank, my bank, had to step in and essentially backstop these auctions. And the amount of debt we need to sell is only going up. See that 39 trillion? That's just the tip of the iceberg. Underneath that, we have 73 trillion of unfunded liabilities or promises made to the American people, Social Security and Medicare, that are absolutely still going to come due even though they're not talked about enough. Throw in on top of that a war in Iran and an escalation in the Middle East, and we're going to have a major defense budget increase. We are going to have a price tag for this war that we don't even know what it is yet. We all know the debt is big, but it is structurally and mathematically guaranteed to grow faster than anything we could do to try and stop it. At this point, there is no growth that can compete with the rate that the debt is growing. And this comes at a time when buyers of U.S. debt are disappearing, not only because they're worried about how they will get paid back. Yeah, sure, they'll get paid back nominally, but in real terms, if the United States is forced to continue to print dollars, real value will be less. Add on top of that the weaponization of the dollar and the counterparty risk, and nations are running for the exits. All of this is happening that at the same time, the U.S. economy is slowing. Inflation is absolutely still here, with many analysts predicting it might hit 3.8% or higher by the end of the year. Tell me what you think. Drop your predictions in the comments below. Do you think inflation could hit double digits this year? It might sound far-fetched, but maybe not once I tell you what could be coming next. Today's structural crisis is leaving the Fed with 2 options. Option number 1, raise the rates to fight inflation, but detonate the debt. Option 2, cut rates to relieve the pressure, but inflation runs rampant. Now, you might be sitting there thinking, so what? It's not like they've really cared before. Or, yes, technically on paper, the Fed has a dual mandate, one half of which is stable prices, which honestly sounds like a punchline at this point, but there is a valid reason why they wouldn't want to cut rates in an inflationary scenario, because it exposes the fact that they are no longer operating under the guise or illusion of their dual mandate, and instead are operating under a policy of U.S. debt. This is a catch-22. But what if there were a third option, one that they've used before and one that we should be terrified of? Now, I'm getting ahead of myself with the consequences, but let's break down what exactly yield curve control is and how it works. As yields on U.S. debt continue to raise to unsustainable rates, the Fed could step in and say, you know what, we're going to set a ceiling on this debt, say 3% on a 10-year Treasury, and we'll use whatever means necessary to make sure that that ceiling stays in place. Whatever means necessary. I'm sure you can guess where this is going. What they're really saying is that no matter how low demand gets, no matter how many buyers walk away, they will step in and ensure that the demand is there by creating the demand themselves, aka firing up the old money printing machine, creating more units of currency out of thin air, and buying our own debt. But before we get into the real consequences for you and I, tell me your thoughts in the comments below. Do you think this is a tool that the Fed would enact? And if so, could they do it sooner rather than later? Let me know down below. Because I'm not saying that they'll want to use this tool. In fact, it's the opposite. I think that the second they do enact a yield curve control, they're showing us just how far along we are throughout this currency life cycle. It will be a desperate measure. But for anyone out there saying this is too extreme, the Fed would never do that. They already have. During World War II, the debt to GDP ratio jumped from 40% in 1941 to over 100% just 5 years later. During this period of time, faced with massive spending and huge borrowing costs, they enacted yield curve control, capping yields which allowed them to borrow cheaply. But guess what else happened? Anytime yields were pushed higher, the Fed stepped in, printing more dollars. So inflation ripped higher to 18% during this period of time. Savers were wiped out. Yeah, the system was saved, but ordinary American people lost everything. But today, the situation is even worse. Our debt to GDP ratio is even higher. The debt that we are facing is 10 times what it was back then. 10 times in real terms. And on top of that, our credibility is worse. And the yields that we would be capping are double that of what they were during World War II. But not even just that, you also have to think about the fact that on the other side of World War II, there was an industrial boom. Today, there is no boom. This isn't wartime spending. This is structural spending. The system itself is crumbling. And how it shows up is your dollars losing value. If you want a modern case study, we can just look at Japan, who enacted yield curve control, YCC, from 2016 to 2024. And what happened to the yen during that period of time? Yeah, sure, the government was able to borrow cheaply, but the yen lost over 50% of its purchasing power. Again, everyday citizens were the ones who paid the price for government spending. See, they get you because if it's taxes, I see people all the time in the comments saying, oh, they can't tax me. Or, oh, it's not my debt, right? I'm not responsible for that. I'm not going to pay that. They can't get me. But they do. They do by devaluing every single dollar. And that includes all dollar-denominated assets that you have. Everything from your annuity to your savings account to your retirement. They all touch the dollar, mean they all will be devalued as part of this process. It's why I personally am such a big believer in sound money, because if you hold it, you own it. This is not going to get devalued. They're not creating more units of currency because this isn't currency, right? This is real, tangible money. Now, I know there's a lot happening right now. It's accelerating fast, and that can be scary. But that is why I am so excited to share with you that I will be doing another webinar called Surviving the Reset, the 4 stages of a currency life cycle, right? This is exactly where we are right now. How to protect yourself against what's coming next. All the information that your analyst won't give you. And to make it even better, it is 100% free because I want everyone to have access to this information. Now, all you have to do is register to save your seat. Again, completely free. It will be on April 21st, that's a Tuesday, at 9:30 a.m. Pacific, 12:30 p.m. Eastern, and I hope to see you there. In fact, once you register, again, you can do it by scanning the QR code or clicking the link in the description below. Also, leave me a comment. Let me know that I'm going to see you there, because it will be 100% live, and I will be doing a live Q&A at the end too, taking all of your questions. And I'm really excited about this, because it was the first webinar I ever did, and we're running it back with more information, because so much has changed in the last 6 months since I did it before. And many of you have asked and said, what is the reset? How do I prepare? What's coming next? What happens if I'm not prepared? what assets perform differently in the reset. And those are all things we're going to be covering. So again, make sure you join. And in the meantime, if you have any questions at all about your portfolio, about how to protect yourself, about what's coming next, call us at the number below. Talk to one of our expert analysts. We here, the ITM family, we have been helping people for the last 30 years protect their wealth because we study currency life cycles just like the one we're living through now and how to protect your wealth. And in the meantime, thank you so much for being here.